Are there companies in the portfolios that you look at where we can actually look at the standalone for the GRE and say, yeah, actually that is stronger than the country it's in? Ying?
Yeah, of course. In Asia, for example, in China, in the oil and gas sector, we have CNPC, which is the largest integrated oil and gas company in China. The standalone credit profile has been consistently strong, and we assess it at AA-. But under the GRE criteria, it's still the rating is being capped by the China sovereign at A+. And the same story goes for Petronas, which is the national oil company for Malaysia. The standalone credit profile, again, just like CNPC, very strong reserve profile and production profile, and consistently strong financial position with a sizable net cash position. So at some point, I think Fitch did rate the Petronas above the sovereign rating, but today we have it capped at the Malaysia's sovereign rating at A-.
Yeah. I was actually the lead analyst the last time we had Petronas, which is a long time ago now.
Very long time ago.
Criteria have changed in the meantime. Lucas, Latin America?
Yeah, continuing with the oil and gas trend, the first one that comes to mind will be YPF in Argentina. So YPF, first of all, the rating is very constrained because of the sovereign. So we have a B outlook positive capped by the rating of the sovereign. Whereas the standalone credit quality, we think it commensurates with a BB rating. So that would be one case, oil and gas. The other one will be perhaps Colombian utilities. Some of the Colombian utility companies on a standalone, when we look at the company or a transmission company, for example, ISA in Colombia, is a very conservative capital structure with a very highly stable and predictable cash flow, whereas the standalone commensurates with a BBB+, as well as EPM, the local utility company, also very conservative capital structure and very stable and predictable cash flows.
Okay. Were there, again, looking to Lucas and Ying, were there particular, as you look at that chart, do the sectors vary significantly by region of the ones where we've ended up looking at them, that make up the portfolio?
I think in APAC, it's about the same as the overall portfolio. If we look at the APAC region, I would break it into China and outside China. And China, I think like Frederick mentioned, the sectors are more widely dispersed. So if we've got energy utility companies being affected by the GRE criteria, which is China Nuclear Power Corporation. Previously, the rating was equalized with the Chinese sovereign rating at A+. Under the GRE criteria, one particular factor which we sort of distinguished versus the other large GREs, such as the oil majors, is the first one, status, ownership, and control, where the three oil majors and the two duopoly power grids, State Grid of Corporation and China's Southern Grid, they scored very strong under the first factor, whereas for CGN, we have this strong. The difference is mainly because as we understand the way how SASAC, which is the state shareholder in Chinese central SOEs, supervises and manages these SOEs, is that the three oil majors and the two power grids fall into this camp, which they consider to be the most strategically important and critical. And their chairman and senior management are directly appointed by the party. Whereas for other central SOEs, including CGN, their management chairman are appointed by SASAC. So in terms of appointment of leadership, which is actually a very critical factor in assessing the relative importance of SOEs in China, we draw the distinction between very strong and strong for CGN versus the oil majors. Outside China, going back to still sticking with China, I think we also have a couple of names from the industrial space where we took rating actions under the GRE criteria. So we've got one, actually we've got two related to the agricultural space. One is COFCO, Hong Kong, and the other is Sinochem Hong Kong. And both, actually, the ratings got upgraded. And the main driver is under the GRE criteria. We assess their social political impact of default to be very strong. That's because both entities, play a pretty critical role in some part of the food value chain. COFCO is responsible for, the policy grain reserves, and it has probably, the largest food distribution network in China, whereas Sinochem is the largest seed producer in China, and it's also the largest fertilizer producer. So they, benefit from very strong scoring under social political impact of default. Outside China, I think I would agree with the pattern from this chart that energy and utility space are where we have the most GREs, but rating actions have been quite limited under the GRE criteria. We've got one being affected in Korean District Heating Corp, which got downgraded by a notch, but then we upgraded to Naga, the utility in Malaysia. But the rest of the sectors outside energy utilities in the APAC market, non-China APAC markets, we don't have that many GREs to start with. So yeah.
Yeah, and it is. It's just worth underlining for the audience. The size of the portfolio in China, it sort of outstrips every other country I think that we have in terms of the number of GREs by quite some distance, because of the way that the economy is managed. Yeah. Lucas, in terms of, is that similar to the sectors that you saw in Latin America, or?
So Latin America was also very concentrated on energy and utilities. And I would say the range of scores wasn't as wide as this. It was more concentrated. So if we go to the energy spectrum, they were scoring all of them on the very high end of the scale, maybe from 45 to 55, especially because of the high, very strong socio-political implication of default. So when we go down the list, most of these companies are very high component of the supply of energy for the country, to the point where the company might be the sole supplier of an energy component. In the case of Mexico, Pemex will be the sole supplier of liquid fuel for the country. Right. Ecopetrol in Colombia is going to be pretty much the sole supplier of liquid fuels in the country. So the socio-political impact of not meeting the financial obligations for these entities will be on the very strong aspect. ENAP will be a similar case with 60% market share. Petroperu will be also very similar, not 100%, 55% market share, but on a socially sensitive areas of the country is 100% participation. So it will be more concentrated there. On the utilities, having the region mostly being self-sufficient on electricity, they tend to score lower on the social political impact. As a default, will probably not have any negative consequences on the operations of the companies.